Hello, everyone. I'm Julia Charlton, and I'm delighted to be here with you today to talk about the amendments to the Hong Kong Stock Exchange's Corporate Governance Code and related listing rules that will come into force on the 1st of July 2025, subject to transitional provisions for certain new requirements relating to listed companies' independent non-executive directors, normally referred to as INEDs, and which I'll talk about later. So moving on to the corporate governance amendments. As you probably know, the corporate governance obligations and disclosure requirements for Hong Kong listed companies are set out in the main board and GEM listing rules and in the Corporate Governance Code, which is Appendix C1 to both sets of rules. The Corporate Governance Code's provisions consist of principles, mandatory disclosure requirements, code provisions, and recommended best practices. Mandatory disclosure requirements are compulsory provisions that all listed companies must comply with. Non-compliance with these requirements constitutes a breach of the listing rules. The code provisions, on the other hand, apply on a comply or explain basis. This means that listed companies can deviate from the code provisions depending on their circumstances, but must give a reasoned explanation for any deviation in their annual corporate governance reports. Recommended best practices are voluntary guidelines. Listed companies are encouraged but not obliged to disclose whether they've complied with these practices. The listing rule amendments I'm going to talk about today were the subject of the Stock Exchange's consultation process, which concluded in December 2024. The Exchange set out its proposed changes to the Corporate Governance Code and related listing rules in a consultation paper published in June 2024. According to the consultation paper, these were based on the Exchange's analysis of a sample of listed companies' compliance with the corporate governance requirements in 2022, its review of the corporate governance requirements of stock exchanges in the UK, Singapore, Australia, Malaysia, and mainland China, and stakeholder feedback. In the consultation paper, the Exchange stated the overall aim of the proposed changes as being to strengthen the corporate governance practices of Hong Kong listed companies. It listed its specific aims as improving board effectiveness and independence, increasing board and workplace diversity, enhancing the Corporate Governance Code's risk management and internal control provisions, and encouraging listed companies to improve their capital management by introducing increased disclosure requirements regarding listed companies' dividend policies and their board's dividend decisions. The Exchange published its consultation conclusions in December 2024, which noted that all the proposed amendments were supported by a majority of the 261 respondents to the consultation paper. The Stock Exchange is therefore adopting almost all of the proposed amendments with various modifications and clarifications to address the concerns of respondents to the consultation. The Exchange has also changed the implementation date of the amendments to 1st July 2025 rather than 1st January 2025. It says in the consultation conclusions that this means that the new requirements under the revised Corporate Governance Code and related listing rules apply to corporate governance reports and annual reports for financial years starting on or after the 1st of July 2025. Transition periods will be allowed for the new rules, imposing caps on the number of Hong Kong listed company directorships INEDs can hold and the number of years INEDs can serve with the same listed company, which I'll talk about later. The Exchange has said that it will publish guidance to assist listed companies in complying with the new corporate governance requirements in the Corporate Governance Portal on its website in the first half of 2025. The new guidance will also address the requests for clarification and guidance received from respondents to the consultation paper. The guidance will be in the form of a new corporate governance guide, which will supersede the Exchange's corporate governance guide for boards and directors published in December 2021. Improving board effectiveness for Hong Kong listed companies. Looking firstly at the Exchange's proposal that listed companies should appoint a lead INED, the revised Corporate Governance Code will add a new recommended best practice, C18, to encourage Hong Kong listed companies with a board chairman who's not an INED to appoint a lead INED. The lead INED's role will be to serve as an intermediary for the other directors and shareholders and to act as an alternative communication channel when normal communication channels with the board chair or management are inadequate. The Exchange originally proposed making the lead INED provision a code provision. It said in the consultation paper that investors had complained of lack of access to the board and to INEDs in particular, especially in the case of listed companies that are family controlled or have the same person acting as both chairman and chief executive officer. The aim of introducing a lead INED provision was therefore to provide a channel of communication to allow shareholders, particularly minority shareholders, to understand the actions taken by INEDs in performing their responsibilities. According to the Stock Exchange's consultation conclusions, there was majority support for the new code provision, and some respondents proposed upgrading the lead INED provision to a mandatory rather than comply or explain provision. There was, however, considerable opposition to the proposal, with opposing respondents questioning the need for appointing a lead INED, given that listed companies are already required to have a shareholders' communication policy and shareholder communication channels in place under Mandatory Disclosure Requirement L. Others commented that a lead INED may be less beneficial for listed companies with a concentrated shareholding structure. To address these concerns, the exchange decided to introduce the designation of a lead INED when the board chair is not an INED as a new recommended best practice rather than as a code provision. The Stock Exchange will publish guidance in the new Corporate Governance Guide on the expected role and functions of lead INEDs and on how lead INEDs' responsibilities differ from those of the board chair. In the consultation conclusions, the exchange also encouraged investors to proactively communicate their expectations as to the responsibilities of lead INEDs to listed companies. The exchange also clarified that the additional responsibilities of lead INEDs will not result in increased liability. All directors, including lead INEDs, will have the same fiduciary duties and the same level of liability. The consultation conclusions also clarified that an announcement under Main Board Listing Rule 1351(2) or GEM Listing Rule 1752 will not be required on the designation of a lead INED. However, when there is a change in the designation of a lead INED, listed companies should publish an updated list of directors stating their roles and functions on their own website and the exchange's website as provided by Code Provision B12. Listed companies that appoint a lead INED will also be required to disclose this in their corporate governance reports under revised mandatory disclosure requirement BA. New recommended best practice C18. As to the requirements for a lead INED on other stock exchanges, the London Stock Exchange's Corporate Governance Code requires a lead INED to be appointed on a comply or explain basis. Its role is to provide a sounding board for the chairman and to act as an intermediary for the other directors and shareholders. However, the shares of UK-listed companies, unlike those of Hong Kong-listed companies, are typically more widely held, which possibly justifies the role of a lead INED as an additional channel of communication between shareholders and the board. The requirement to appoint a lead INED for companies listed in Singapore applies on a comply or explain basis only, where the chairman is conflicted or not independent. Companies listed on NASDAQ and the New York Stock Exchange are not required to appoint a lead INED. That said, a considerable number of US-listed companies have voluntarily appointed a lead INED, generally where the CEO is also the board chair. There's no requirement for US-listed companies to have separate individuals performing the roles of CEO and chairman, as there is under the Hong Kong Corporate Governance Code, where it is a code provision. According to the academic literature, the role of a lead INED was developed in the 1990s in the US to provide an alternative for listed companies that were unwilling to separate the role of CEO and board chair. The lead INED role was developed as a way to allow them to enjoy the benefits of having a single person as both CEO and chair while achieving a more independent board through the appointment of a lead INED. The idea was that a listed company's INEDs would be more effective if they had leadership from the lead INED. The appointment of a lead INED was intended to act as a counterbalance to a single CEO and chair. US-listed companies that appoint a lead INED typically define the scope of their duties in a lead independent director charter. The amendments to the Corporate Governance Code will add new code provision F11, which will require listed company boards, particularly INEDs, to be accessible to shareholders to facilitate constructive engagement and understanding of shareholders' views on matters affecting the listed company, including its governance and performance against its corporate strategy. New mandatory disclosure requirement LD will require disclosure in the corporate governance report of information regarding the board's engagement with shareholders during the reporting period, including on the nature and number of frequency of shareholder engagements, the group or groups of shareholders and representatives of the listed company involved, and the listed company's approach to following up on the outcomes of these engagements. The Exchange's stated aim in introducing these provisions is to facilitate constructive communication between shareholders and the boards of listed companies on issues relating to governance and performance. The listing rule changes include new requirements for directors of listed companies to receive mandatory continuous professional development, which I'll refer to as CPD, in each financial year of the relevant listed company on specified topics under Main Board Rule 309F and Gem Rule 502F. The Exchange's stated aim in introducing the requirement is to ensure that directors are kept up to date on the latest regulatory developments and able to ensure listed companies' regulatory compliance. The revised listing rules will not specify a minimum number of CPD hours. They must, however, cover at least the topics specified under the listing rules, which, as you can see on the slide, are the roles, functions and responsibilities of the board, its committees and its directors and board effectiveness, the listed company's obligations and directors' duties under Hong Kong law and the Exchange's listing rules, and key legal and regulatory developments, including listing rule updates relevant to the discharge of those obligations and duties. Corporate governance and environmental, social and governance ESG matters, including developments on sustainability or climate-related risks and opportunities relevant to the listed company and its business, risk management and internal controls, and updates on industry-specific developments, business trends and strategies relevant to the listed company. The mandatory CPD requirements will not apply to overseas companies with secondary listings on the exchange by virtue of Main Board Rule 19C11. The revised listing rules also require first-time directors to complete at least 24 hours of CPD within 18 months of their appointment on the same specified topics. First-time directors are defined as directors who have never been a director of a Hong Kong listed company and directors who have not served as a director of a Hong Kong listed company in the 3 preceding years. The number of CPD hours is, however, reduced to 12 hours for first-time directors who have acted as a director of a company listed on an overseas exchange within the 3 preceding years. The overseas exchange does not need to be one that is included in the list of recognized stock exchanges that is included on the exchange's website. Code Provision C11 currently requires newly appointed directors to receive comprehensive, formal and tailored induction, but does not specify what it should cover or how long it should last. According to the consultation paper, the 24 hours of CPD training for first-time directors under the new listing rule will be required in addition to the general induction training that listed companies are already required to provide to new directors under Code Provision C11. If a first-time director resigns before completing the minimum number of CPD hours and is subsequently reappointed as a director of another Hong Kong listed company within 3 years of the conclusion of their first appointment, the director will need to complete the remaining CPD hours within 18 months from the date of the subsequent appointment. The Exchange's consultation conclusions clarified that where directors are also required to fulfill training requirements of other professional organisations, such as CPD training requirements for solicitors or accountants, these hours can be counted towards the listing rule's mandatory CPD requirement if the relevant training is on one or more of the topics specified in the listing rules. Training received in the capacity as a director of other Hong Kong listed companies or overseas listed companies can also be counted towards the listing rule's mandatory CPD requirement, provided that the training covers one or more of the specified topics, is not company-specific and covers Hong Kong-specific requirements. The Exchange will implement a new mandatory disclosure requirement B1, setting out the details of directors' CPD that must be disclosed in listed companies' corporate governance reports. Listed companies will be required to confirm that all their directors have fulfilled the CPD requirements during the reporting period. In the case of first-time directors, the disclosure must include a confirmation that each relevant director has completed the minimum CPD requirement under Main Board Rule 309H or Gem Rule 502H. The disclosure for each director will also need to include details of the total number of CPD hours completed and the format or mode of CPD undertaken, including whether an external or internal provider was used or whether the professional development was the result of self-study. Corporate governance reports must also disclose for each mode of CPD completed by each director, the number of hours completed, the training topics covered, and a description of the relevant training provider. For example, the names and/or types where applicable. Listed companies are free to choose the format of CPD that directors undertake, that is, whether it's provided externally, internally, or through self-study. The Exchange noted in the consultation conclusions that while internal training may be appropriate for training on industry or company-specific topics, it encourages the engagement of external service providers to deliver CPD on the regulatory and legal responsibility of directors and boards. Looking now at the requirements on board performance reviews. New Code Provision B14 will require listed companies to conduct a formal evaluation of the board's performance at least every 2 years. This will replace the current recommended best practice, which encourages boards to conduct regular evaluations of their performance, but provides no guidance on what is meant by regular. The Exchange's rationale for upgrading the board performance review recommended best practice to a code provision is that it considers that these reviews help the board to identify areas for improvement. The new code provision will also require listed companies to disclose in their corporate governance reports whether a board performance review was conducted during the reporting period, and if not, when the next board performance review will be conducted. Where a board performance review was conducted, listed companies will need to disclose whether the review was conducted internally or by an external services provider, and how the review was conducted, including information as to its scope and those involved in conducting the review. If an external review was conducted, disclosure will be required of the relationship between the external provider and the listed company and/or its directors, if applicable. Listed companies will also be required to disclose the findings of the review, including any significant areas of improvement identified and the measures taken or planned as a result of the review. New Code Provision B31E will also be introduced to impose on the Nomination Committee a duty to support the listed company's regular evaluation of the board's performance. The Exchange has said that it will include guidance in its new corporate governance guide on the expected scope of the board performance review and the level of detail required in relevant disclosures. In its consultation conclusions, the Exchange said that the review should be of the whole board's performance rather than of individual directors, and that listed companies are free to choose whether they conduct board performance reviews internally or externally, and to structure reviews in a way that best suits the company's specific circumstances. Looking at the requirements for board performance reviews on other stock exchanges, the London, Australian and Singapore stock exchanges all require the conduct of a board performance review and disclosure of its conduct in listed companies' annual reports on a comply or explain basis. In the UK, that review is required annually. The board chair should also commission a regular external board performance review, and for FTSE 350 companies, that is, larger issuers, that external board performance review should be conducted at least every 3 years. In the US, the corporate governance guidelines of companies listed on the New York Stock Exchange are required to provide for the board's annual self-evaluation of its performance. The Exchange will introduce new code provision B15 requiring listed companies to maintain a board skills matrix and disclose it in their corporate governance reports. The Exchange's rationale for the new requirement is that it considers that a well-maintained board skills matrix will better present and evaluate the experiences, skills, qualifications and expertise of the board collectively and measure them against the long-term strategy and goals of the listed company. The new code provision will set out the minimum information that must be included in a listed company's board skills matrix. This requires the board skills matrix to include details of the board's current mix of skills and an explanation of how the combined skills, experience and diversity of its directors, serve the purpose, values, strategy, and desired culture of the listed company. The matrix will also need to set out any additional skills the board is looking to acquire, its plans to acquire those skills, and how the company achieved or progressed its plans to obtain additional skills in previous years. Under amended Code Provision B31, the Nomination Committee will have a duty to assist the board in maintaining a board skills matrix. The Exchange will also issue additional guidance on the suggested format and scope of the skills matrix and the level of detail required in relevant disclosures in its new corporate governance guide. The Exchange will add new listing rules imposing a hard cap of 6 on the number of concurrent Hong Kong listed company directorships an INED can hold. Directorships will include both executive and non-executive directorships, as well as INED directorships. According to the consultation paper, at 31st of December 2023, there were 23 INEDs serving on 7 or more listed company boards, on the boards of 181 listed companies, which is around 7% of all Hong Kong listed companies. 5 of these INEDs held 10 or more listed company directorships. The Exchange's rationale for imposing a cap is its concern that directors with a large number of listed company directorships may not have enough time to properly discharge their duties with respect to each of the listed companies whose boards they sit on. In the consultation paper, the Exchange emphasised the role INEDs are expected to play in scrutinising listed companies' performance, acting as an independent voice and taking the lead where potential conflicts of interest arise. The Exchange previously proposed a cap on the number of listed company directorships INEDs are allowed to hold in 2010, but the proposal was opposed by a significant majority of respondents to the consultation. The Exchange said in the consultation paper that it considers that the demands on listed company boards have become more complex and time-consuming, and this was the reason for it proposing a hard cap again to prevent INEDs from holding multiple directorships with Hong Kong listed companies. The Exchange will provide a 3-year transition period to allow time for INEDs with more than 6 listed company directorships to be replaced. INEDs holding more than 6 Hong Kong listed company directorships as at 30th of June 2028, must comply with a new cap by the conclusion of the first annual general meeting held on or after the 1st of July 2028 by any of the companies on which he or she is a director. This effectively delays the implementation of the new listing rule by 3 years. Until 30th of June 2028, where a listed company board proposes a shareholders' resolution to approve the appointment of an INED who will be holding their 7th or more Hong Kong listed company directorship, it will still need to comply with the current requirement to explain in the shareholder circular or the explanatory statement provided with the notice of general meeting why it believes that the relevant INED will still be able to devote sufficient time to the board as required by Code Provision B34B. As to the position for new listing applicants, the Exchange says in its consultation conclusions that from the 1st of July 2025, it will not list any listing applicant having an INED with more than 6 Hong Kong listed company directorships. Companies applying to list after the 1st of July 2025 will therefore need to ensure that none of their proposed INEDs have more than 5 other listed company directorships. The new cap on the number of Hong Kong listed company directorships INEDs can hold makes it an outlier among international stock exchanges. None of the exchanges in Australia, Singapore, the UK, Malaysia, or the US cap the number of concurrent directorships and instead require disclosure of directors' other material directorships. Some companies listed on NASDAQ and the New York Exchange have themselves adopted to impose a cap, which varies depending on the particular company. For example, Apple Inc. has a cap of 5 listed company directorships, while Microsoft Corporation has a cap of 4 listed company directorships. The Exchange will also amend Mandatory Disclosure Requirement ED3 to require the Nomination Committee to annually assess each director's time commitment, board contribution, and ability to discharge their responsibilities effectively, and to disclose the results of that assessment in the Corporate Governance Report as part of its summary of work done. The assessment should consider circumstances such as the nature of the director's involvement on the board, their professional qualifications and work experience, their other Hong Kong listed company directorships, and other significant external time commitments. The same set of review criteria should be applied to all directors, including those on the nomination committee. Significant external time commitments under this requirement will broadly include directorships of companies listed on other overseas exchanges, full-time occupations, major consultancy work, major public service commitments, as well as directorships of and involvement in statutory bodies or non-profit organisations. The Exchange clarified in the consultation conclusions that while the assessment will need to be conducted for all the directors of a listed company, the corporate governance report will not need to make disclosures for each director by name. The Exchange will provide guidance on the assessment criteria and the extent of disclosure expected in its new corporate governance guide. New 9-year cap on listed companies' INED's tenure. Looking now at the Exchange's proposal to impose a 9-year cap on how long a person can serve as a listed company's INED, this proved to be one of the most controversial of the proposals. Some respondents considered that the proposed cap would be beneficial in ensuring periodic board refreshment and bringing fresh perspectives to the board. However, opposing respondents were of the view that INEDs who have served on the board for a longer period bring valuable insights based on their experience and knowledge of the listed company, which is particularly useful for companies operating in specialised industries. According to the consultation paper, at the end of December 2023, around 1,500 directorships were held by INEDs who had served more than 9 years. I'll refer to these people as long-serving INEDs. So these long-serving INEDs sat on the boards of around 810 listed companies. That's about 31% of all Hong Kong listed companies. In addition, around 30 listed companies had INEDs who were all long-serving INEDs. According to the consultation paper, the Exchange considers that long-serving INEDs' familiarity with the listed company's management is likely to impact their independence and objectivity, and that removing long-serving INEDs from boards will increase board independence. The Exchange decided to adopt the 9-year hard cap of INED's tenure, its aim being to encourage board refreshment and prevent groupthink. Under the new listing rules, listed companies will not be allowed to have INEDs who have already served more than 9 years as an INED on the listed company's board. This means that listed companies will need to remove a long-serving INED at the first annual general meeting held after the end of the director's 9-year tenure, although they will be allowed to retain the individual in the capacity of a non-executive director or executive director. The 9-year period will start from the date of the INED's appointment or from the date of listing if the INED was appointed before the company listed on the Exchange. If an INED ceases to serve as a listed company's INED for less than 3 years and is subsequently reappointed by the same listed company to serve as an INED, the period when the individual was not an INED will still count towards the 9-year tenure. However, the Exchange will allow long-serving INEDs to be reappointed as INEDs by the same listed company after a 3-year cooling-off period, during which the long-serving INED must not have been a director of the listed company, its holding company, any of their respective subsidiaries or core-connected persons. The 3-year cooling-off period replaces the 2-year cooling-off period originally proposed. On reappointment as an INED after the cooling-off period, the INED must also be able to satisfy the listing rules independence guidelines. New 9-year caps on listed company INED's tenure. Taking into account the comments from respondents regarding the difficulties in recruiting suitable directors to replace long-serving INEDs, the Exchange will adopt a 2-phased approach over 6 years to implement the new requirement. This replaces the 3-year transition period proposed in the consultation paper. Under the new transitional provisions, which are set out in Note 1 to the new listing rules, at the conclusion of listed companies' first annual general meetings, held on or after the 1st of July 2028, long-serving INEDs must not represent a majority of the company's INEDs. This means that at least half of a listed company's INEDs must have served for less than 9 years at the conclusion of that annual general meeting. Then, at the conclusion of the listed company's first annual general meeting, held on or after the 1st of July 2031, listed companies must not have any long-serving INEDs on the board. The exchange expects the extended transition period to ease the burden on listed companies in replacing their long-serving INEDs. It notes, however, that it encourages listed companies to plan ahead and avoid abrupt changes to their board composition, which could result in gaps in its experience and governance. The exchange also confirmed in the consultation conclusions that the current requirements relating to long-serving INEDs will continue to apply during the transition periods. This means that for annual general meetings held on or before the 30th of June 2028, listed companies whose INEDs are all long-serving INEDs must disclose each INED's length of tenure in the shareholders' circular or explanatory statement accompanying the notice of the AGM, and must appoint a new INED at the AGM meeting, as required by Code Provision B24. In addition, for all annual general meetings held on or before the 30th of June 2031, including those held on or before 30th of June 2028, the requirements for a long-serving INED to be reappointed under a separate shareholders' resolution and for the papers to shareholders to state why the board still believes the long-serving INED to be independent, as required by Code Provision B23, will continue to apply. Regarding the requirements for other stock exchanges, the Singapore Stock Exchange also imposes a cap of 9 years on INED's tenure, while the Malaysian exchange imposes a 12-year cap. Mainland China has the strictest requirement prohibiting INEDs from serving more than 6 consecutive years. The commentary in the Australian Stock Exchange's Corporate Governance Code gives more than 10 years tenure as an example of factors that may affect directors' independence, and it recommends boards to regularly assess the independence of any director who has served more than 10 years. However, it also notes that, quote, the mere fact that a director has served on a board for a substantial period does not mean that the director has become too close to management or a substantial holder to be considered independent, unquote. Similarly, the UK warns that more than 9 years tenure may impact independence, but does not prohibit long service. There are no requirements to limit INED's tenure on the New York Stock Exchange and NASDAQ, but companies are free to impose one in their corporate governance guidelines. The US Exchange's guidelines don't distinguish between INEDs and other directors. The lead independent director of JP Morgan Chase, for example, has served as a company director for over 20 years. US-listed companies generally include statements on directors' length of service in the proxy statement issued for general meetings that will re-elect directors. Eli Lilly and Walmart, which are listed on the New York Stock Exchange, have said in their proxy statements that they believe the company benefits from having directors with both long and short tenures. NASDAQ-listed Apple, Microsoft, and Nvidia Corporation have also commented in their proxy statements on the valuable insights and understanding long-serving directors bring to the board. The exchange will adopt its proposed amendments to Mandatory Disclosure Requirement BA to require listed companies to disclose the length of tenure and current period of appointment of all their directors by name in their corporate governance report. Turning now to the exchange's diversity-related requirements, one of the main focus areas of the consultation was improving board and workforce diversity. The listing rules currently require all listed companies to have a board diversity policy and to have appointed at least one female director to the board by the 31st of December 2024. At least one director of a different gender on listed companies' nomination committees, new Code Provision B35. The exchange will now adopt new Code Provision B35 to require at least one director of a different gender to be appointed to the nomination committee of Hong Kong listed companies. The exchange considers that since the nomination committee is primarily responsible for board appointments, this requirement will improve board diversity and broaden listed companies' exposure to a greater number of potential director candidates. According to the exchange's consultation paper, at the end of December 2023, around 17% of Hong Kong listed company directors were women, and around 19% of Hong Kong listed companies still had all-male boards. The exchange will adopt two other amendments aimed at increasing gender diversity and ensuring that listed companies have an appropriate focus on developing a diverse pipeline of candidates for the board. The first of these will amend Main Board Listing Rule 13 92.1 GEM Listing Rules 17.10.4.1 and Mandatory Disclosure Requirement JB to require listed companies to maintain and disclose a workforce diversity policy in addition to a board diversity policy. The Exchange's stated aim in imposing the new requirement is to promote inclusion and diversity across the whole workforce. Under the amended listing rules and mandatory disclosure requirement, the corporate governance report must include the full workforce diversity policy or a summary of it with details of any plans or measurable objectives, for example, numerical targets and timelines for achieving gender diversity, the progress on achieving these objectives, and, where applicable, any mitigating factors which make achieving gender diversity in the workforce less relevant or more challenging. The Exchange acknowledged that it may be challenging for some listed companies to set measurable objectives due to the size of the company and the characteristics of the relevant industry. For this reason, the setting of measurable objectives for workplace diversity is not compulsory. The second will amend Mandatory Disclosure Requirement JA to require listed companies to review the implementation of their board diversity policy at least once every year and disclose the results of the review in their corporate governance report. The disclosure on board diversity will be required to include the measurable objectives, such as numerical targets and timelines the listed company is set to promote gender diversity on its board, the measures adopted to develop a pipeline of potential successors to the board to achieve gender diversity, and the results of the review of the implementation of its board diversity policy, including the progress towards achieving the board diversity objectives and how the listed company has arrived at the disclosed conclusion. According to the consultation conclusions, the Exchange considers that these reviews and disclosures will assist listed companies in assessing whether the board diversity policy is adhered to and whether the diversity goals are met. It clarified that annual reviews will still be required even if the listed company has already achieved its current board diversity objectives, and that listed companies should consider the need for a more gender diverse board despite the listing rules not prescribing a fixed gender ratio. The Exchange will also require separate disclosures of the gender ratio of the workforce, including senior management, and the gender ratio of senior management under revised Mandatory Disclosure Requirement JC. The Exchange explained in the consultation conclusions that separate disclosures will provide shareholders with a clearer perspective of the gender ratio of listed companies and enable listed companies to better assess whether their diversity strategies are effective. The Exchange's existing guidance on arrangements during temporary deviations from the requirement for listed companies to have directors of different genders on the board will be codified in Main Board Listing Rule 1392.2 and in the corresponding GEM listing rule. Under the amended listing rules, listed companies that cannot comply with the requirement to have at least one director of a different gender on the board must immediately publish an announcement explaining the details and reasons for the breach. The listed company must also use reasonable endeavours to re-comply with this requirement on a timely basis, and in any case within 3 months of the breach. Moving on to the new requirements in relation to risk management and internal controls, the Exchange will adopt the proposal to upgrade the requirement to conduct at least annual reviews of the effectiveness of the risk management and internal control systems of the listed company and its subsidiaries to a mandatory one under Mandatory Disclosure Requirement H. It will also adopt the proposed amendments to Principle D2 and Code Provision D2.1, which emphasise the Board's responsibility for listed companies' risk management and internal controls and the conduct of at least annual reviews of their effectiveness. The Exchange stated in the consultation conclusions that in the light of ever-changing business environments, regular reviews of risk management and internal control systems are important to ensure that risks are identified and remediated in a timely manner. The enhanced disclosure requirements are also aimed at providing shareholders with more insight into the management of risks and internal controls of the listed company. The amended Mandatory Disclosure Requirement H will require listed companies to disclose certain information relating to the annual review of their and their subsidiaries' risk management and internal controls in their corporate governance reports. As you will see on the slides, this includes a board statement acknowledging its responsibility for the listed company's risk management and internal control systems, and a statement confirming that the risk management and internal control systems are appropriate and effective. The main features of the risk management and internal control systems in place, including the process used to identify, evaluate, and manage significant risks, and the procedures for ensuring timely and accurate disclosures. Significant changes in the assessment of risks in the risk management and internal control systems, whether the listed company has an internal audit function, the responsibilities of internal departments and external providers for the review, the process used to conduct the review of the risk management and internal control systems, and the frequency of reviews, confirmations from management, the relevant board committees, other internal departments, the company's independent auditors and/or other external providers to support the board's conclusion that the risk management and internal control systems are appropriate and effective. The scope of the review and the results of the review and details of any significant control failings or weaknesses identified during the review and/or previously reported but remaining unresolved, and any remedial steps taken or proposed. The Exchange will not mandate that annual reviews be conducted externally to provide flexibility for listed companies to adopt a mode of review that better suits their circumstances. Appropriate disclosures must be made depending on the mode of review adopted. Amended Code Provision D2.1 will set out the scope of the annual review and will state that these reviews should cover all material controls of listed companies and their subsidiaries, including financial, operational, and compliance controls. Code Provision D2.1 will also require listed company boards to ensure that adequate resources are devoted to the review of the company's management and internal control systems. The Exchange will provide further guidance on the scope and level of detail required in relevant disclosures in its new Corporate Governance Guide. New mandatory disclosure requirement M will not require listed companies to have a dividend policy. However, a listed company that has a dividend policy will be required to disclose the policy or a summary of it in its corporate governance reports. The corporate governance report disclosure must also include the aim or objective of the policy, the board's key considerations when deciding whether to recommend payment of a dividend, and either a confirmation that all dividend decisions made during the reporting period were made in accordance with the dividend policy, or an explanation of any deviations from the company's dividend policy. Listed companies that do not have a dividend policy will have to disclose the fact in their corporate governance reports and give reasons for not doing so. If the board has declared a dividend during the reporting period, regardless of whether the listed company has a dividend policy or not, the listed company must disclose the reasons for any material variation in the dividend rate declared during the reporting period compared to that for the previous corresponding period. If the board has not declared any dividend during the reporting period, the listed company must disclose the reasons for the board's decision and any alternative measures to enhance investor return. The Exchange noted in the consultation conclusions that listed companies are not expected to include confidential or commercially sensitive information in their disclosure. It also encourages listed companies to consider adopting alternative capital management measures to increase investor returns. The Exchange's rationale for the new requirement is that it considers that the disclosure requirements regarding listed companies' dividend policies and board dividend payment decisions will allow investors to make more informed decisions about investing in particular listed companies. The Exchange also noted in its consultation paper that the Tokyo and South Korean stock exchanges have taken steps to encourage listed companies' management to increase shareholder value. Essentially, the management team of listed companies is encouraged to give greater consideration to the cost of capital and profitability, rather than just sales and profit levels, for example, by investing in R&D, which is aimed at allowing listed companies to achieve sustainable growth and increase corporate value over the medium to long term. The Exchange will amend Main Board Listing Rule 1366(1) and GEM Listing Rule 1778(1) to codify its existing guidance on the requirement to set a record date to determine the eligibility of shareholders to attend general meetings and receive corporate entitlements. It will also make consequential amendments to the listing rules to require listed companies to make announcements of the record date and any book closure and of any alterations to the announced record or book closing dates. For rights issues, announcements of the record date must be made at least 6 business days before the record date if there's no book closure. If the books will be closed, the announcement of the record date and book closure must be announced at least 6 business days before the book closure date. In all other cases, the record date must be announced 10 business days before the record date if there will be no book closure. If the books will be closed, the record date and book closure must be announced 10 business days before the book closure date. The exchange will not impose strict requirements on the timing of the record date, but encourages listed companies to set the record date as close to the date of the general meeting or the payment date for entitlements. The listing rules currently require a listed company to provide more detailed information in its annual reports if its financial statements do not give a true and fair view of its state of affairs, results of operations, and cash flows. They don't, however, specify what information needs to be disclosed in these circumstances. In its 2023 review of issuers' annual reports, the exchange set out a recommendation that listed companies which receive a modified audit report should make certain disclosures in their annual reports. The exchange noted in the consultation paper that its recommendation has generally been followed and therefore proposed codifying that recommendation. The exchange will therefore amend paragraph 3.1 of Appendix D2 to the main board listing rules and the note to GEM Listing Rule 1847 to require a listed company who receives a modified auditor's opinion to disclose certain minimum information in its annual report. The minimum disclosures required, as you can see on the slide, are details of the modifications and their actual or potential impact on the listed company's financial position. The management's position and basis concerning major judgmental areas and how the management's view differs from that of the auditors, the audit committee's view of the modifications, and whether the audit committee has reviewed and agrees with the management's position concerning major judgmental areas, and the proposed plans to address the modifications. The exchange states in the consultation conclusions its view that the required disclosure of audit modifications and their impact on listed companies' financial position will provide important information to shareholders. It also clarified in the consultation conclusions that the disclosure requirement on management's position and basis on major judgmental areas will cover any circumstances where the divergence in opinion between the management and the auditors of the listed company resulted in a modified audit opinion. For example, where the management disagreed with the auditor's request for information or audit evidence. The exchange will also adopt its proposed amendments to Code Provision D12 with minor drafting changes, which will give directors the right to receive available monthly management accounts and updates as to the listed company's finances, operating performance, and future prospects, and to request this information if management fails to provide it. Revised Code Provision D12 additionally provides that directors should request this information if it's not provided by management. The exchange noted in the consultation conclusions that the revised code provision will impose an obligation on management to provide information that it has prepared in the ordinary course of the listed company's business. The stock exchange will amend the requirements that apply to the 3 board committees that listed companies are required to have. That's the Nomination Committee, the Audit Committee, and the Remuneration Committee, on adopting written terms of reference and the arrangements when a listed company is temporarily unable to comply with the listing rule requirements. There is currently no listing rule requirement for a listed company's nomination committee to have written terms of reference, as there is for the audit and remuneration committees. As proposed in the consultation paper, the stock exchange will add a new listing rule requirement for listed companies to approve and maintain written terms of reference for the nomination committee that clearly establish its authority and duties. The exchange will also add new listing rule requirements that if a listed company is unable to set up a nomination committee or comply with the listing rules requirements as to its composition or having written terms of reference, it must publish an announcement immediately, setting out details and reasons for the breach, and must ensure that it complies with those listing rule requirements within 3 months from the breach. The new requirement will be set out in Main Board Listing Rule 327C and for listed companies with a weighted voting rights structure in Main Board Listing Rule 8A 28A. The equivalent GEM provision will be set out in Listing Rule 536C. Minor changes will be made to the provisions applicable to the Audit and Remuneration Committees so that the requirements when a listed company is unable to meet the listing rule requirements on the establishment of the relevant committee, its composition, or the maintenance of written terms of reference are consistent across all 3 committees. The Exchange also noted in its consultation conclusions that it received a number of recurring comments on ways of improving listed companies' corporate governance, and that while these would not be addressed as part of the listing rule changes being adopted in July 2025, the Exchange may consider them in future consultations. The comments related to 3 main issues. Some respondents reportedly suggested increasing the minimum number of INEDs from 1/3 to a majority of the members of the board to increase the involvement of INEDs in board matters and enhance talent refreshment. Additionally, some respondents suggested requiring the nomination committee, which can currently be chaired either by the board chairman or an INED, to be chaired by an INED. This would align with the requirements applicable to the Audit and Remuneration Committees. Other respondents commented that INED remuneration in Hong Kong is lower than in some other major markets. They suggested that the Exchange should conduct a market survey of INED remuneration in Hong Kong and include requirements in the listing rules to ensure that INEDs are appropriately remunerated. So that brings us to the end of today's webinar. Thank you again for joining me, and I hope that you enjoyed the webinar, and I hope that I'll see you again. Bye.